Okay, welcome to week 4 of business plan development. Good morning, Eduardo. Uh, this week is our lightest week. We don't have any chapters to write. All we really have are some financials and your mastery assignment. So basically, we have your staffing budget, the startup costs, and then your mastery assignment. So we'll go through those today. The first one is the staffing budget, and the staffing budget is where you're going to have to put the actual cost of your employees. Now, what we want you to do is make sure that the company can support at least one full-time employee. And again, investors will be expecting you to have at least one full-time person. And again, if you're not using investors, you can do what you need to do. But if you're a corporation, you're supposed to have at least one employee. And like I said, the investors are going to be looking to make sure that you can support one person. The information that you have to put in here, there's two areas. There's the management. Let's go to the other one. At the upper part, just like in sales, you have to put in the job description, and you can either look these up. If you need a term, you can look them up in the Bureau of Labor Statistics if you'd like to, or you can just kind of make your own up. I just like to have some type of a descriptor here, so I know whether the numbers are correct. But like I said, I just need really one full-time employee throughout the entire spreadsheet. But the upper part, we give you 4 areas where you can put jobs. The only thing I don't like to see is other, that you're using other, because I won't have an idea of who or what you're hiring. And if you're doing something like we have a student who comes in and does interns, he hires 4 or 5 interns a year and then converts one of those to a full-time employee. He does pay them something while they're there, which is great, but you don't have to pay an intern minimum wage. That is a kind of a loophole in the law. Now, the government has been getting involved in interning because people are saying, I'm being treated like an employee, but I'm not being paid like one. So, I want, they've sued in the past. The courts have kind of sided with them, but in our industry, it's a small industry. And the court cases that I've seen, basically the people won, but now they're kind of blackballed from the industry, and that's not a good thing. So interning is kind of a thing we do in our industry as you learn your business. So, but again, we're talking more from the employer side than from the employee side, but you just want to be aware that there have been some court cases. Once you have your jobs picked out and put in here and spelled correctly, I used to use administration I left an I out of it intentionally just to see if people caught it. But again, make sure you spell the jobs correctly. Now, below each of those tables is another feeder table. And here the names will show up for the 5 job categories that you have available. And then you have to put in the amount that you're paying them annually. Now, we were working this out in class today, and if you're going to pay minimum wage, right now in the United States, it's $7.25 an hour, which works out to a little over $15,000 a year. In Florida, it's $8.25 an hour, so we're looking more at $18,000 a year. But as long as you're paying minimum wage, you're going to kind of be, you're not going to go cross with the Labor Department, because you have to tell them in your state within 20 days when you hire somebody how much you're paying them. So make sure that you pay at least the minimum wage for your state. If you're not sure what that is, there's a website called payrolltaxes.com, payroll-taxes.com. I'll go to it a little bit later. And that kind of summarizes each state and what their minimum wages are, because they can change not only by state but also by city. They can both of those entities can adjust the minimum wage, but as long as you're paying what we call the federal minimum wage, which is $7.25, we're usually okay. But you have to think about, can people live on $16,000 a year? Probably not in Orlando, maybe in the hills of West Virginia, but not in Orlando. So you have to think about, what are my competitors paying and what is ordinary and customary for my industry. So, we had a student who was building a recording studio, and he looked up in Bureau of Labor Statistics, and a mixing engineer in LA makes an average of $48 an hour. And what I use for my multiple is about 2,000 hours. And 40 times 50 is 2,000. That's how many hours you're usually paying in a year. So that's with 2 weeks off without pay. But you can use 2,080 if you want to. It's just easier to do the 2,000 in your head. But 2,000 times 48 is approximately $100,000 a year. And that's what you would put in here for their yearly average wage. Now, if you're paying people, but you've got a base pay and then you're paying commissions with stock or whatever, you still have to figure what is their income from you for the year. So even though you may only pay a base salary of $25,000, if their actual salary for the year is about $50,000, you need to put that in here. And the idea is that if you're going to, and again, I'm a merit person. I like for people to earn their money. So I give them a base salary and then commissions on top of that. That's fine. But you have to be able to account for all of it, because you have to withhold taxes on it. One of the things that you've now become as an employer is the tax collector for the government. And they expect you to capture their federal tax, their state tax, their Social Security, and their Medicare. And so we'll talk about all those as we go through here. But again, think about what their total amount that they make on an annual basis is and put that in here. So I had mentioned $25,000. Well, the government also comes out with other numbers, which is the poverty line. And they consider anybody making more than $25,000 a year not to be impoverished. If you're a family of four, they look at $41,000, $42,000. As long as you're paying that, they're not really going to qualify for food stamps and other things that are considered below the poverty line. So I use those numbers more. I'd rather use those numbers than minimum wage because, number one, I'm not going to get a quality person for minimum wage. We all know that. And in our industry, we're looking for skilled people, and you're going to be competing with other studios or, however you're competing for employees. Those people are going to be paying them more than just minimum wage anyway. So just, again, check around your area, and I look at the job sites and see what people are offering. I look at Glassdoor, which is a website which tracks what people pay. But again, what is ordinary and customary for your industry? So put those numbers in here, and that'll give you what you're paying them per year. And what we do in the spreadsheet is we take the number of employees that you say you have, and we multiply it by 1/12 of the wages and salary, because we're assuming you're paying them the same amount each month. And that's how the math works. So if you've got somebody that you're paying, if you're just working them 3 months a year, just put them in those 3 months. We're going to assume you can hire and fire at will, and that you can get the employees you need when you need them. Because again, we're doing pro forma here. This isn't reality yet. But again, you'll learn over time, well, it's hard to find people at this price at Christmas time, for instance, because Christmas is when Target hires, I think, 40,000 people for their stores for October, November, and December, because that's their biggest retail time. And in the retail business, 70% of their revenue comes in those 3 months. So they're gonna staff up. And so again, what's the pool of people look like? But think about when you're going to actually hire, and you can put them in here. Now, if they're part-time, you can put in half an employee. Now, we're not going to put the salary at half amount, because if you do that, you get in trouble with the labor department, because they can look at your books. So you're going to put the whole amount, but you're going to put half a person in here, or 3/4 of a person if they're working 30 hours, which is still considered part-time. It won't show up on the screen, but it does the math correctly. We were testing it out today. But again, think about how many bodies you're going to need to have at what time of the year. And again, I anticipate that you can hire and fire at will, so it's really up to you. Now, the other two things on the list were benefits and payroll taxes. Now, what benefits are things you're paying for that are above and beyond their salary. And this can be anything from medical benefits to a retirement plan, to you pay for their meals while they're at work, you reimburse them for their meals. All of those things are benefits that you can offer. Do you have to offer any? No. But if your competitor has a medical plan and a retirement plan, that's something that they don't have to, that your employees will have to do themselves. And we'll talk about those as we go through them. But it's not unusual to have a 5 or 10% benefit. Now, if it's a $50,000 employee and you have 10% benefits, it means you have to come up with another $5,000 to employ this person. So that $50,000 employee is now a $55,000 employee, and as far as your books are concerned. So you have to think about, do I need to offer benefits? Small businesses tend not to. Once you get to 50 employees, you are required under the Affordable Care Act, or what people call Obamacare. You have to you have to make health insurance available to your employees. So, and there's all kinds of numbers out there that we can look at, but the main ones are 5 employees. At 5 employees, you have to now pay your workman's compensation and unemployment insurance. Those are statutory. In other words, they're required by law. Some states, that starts at 1. So you have to look at your state and find out, what it is you have to do. Now, as I was telling the ground class today, I use a payroll service because that's their job. And I'm hiring them for their expertise, just like I would a consultant or a human resources person. And the payroll companies today are very sophisticated, but that's their job. And do I have time to follow the changes in the law? I'd rather spend my time making money than trying to figure out if I've got to add 1% to my payroll for a certain thing that the government's now put into place. And we'll talk about those. But the benefits are things that you provide that are enticements. Payroll taxes, those are what we call statutory. In other words, they're required by law. And when we go through these, you'll see that the government loves to make you, as the employer, collect money for them. And so we'll look at what each of those are. Now, the benefits, those are the voluntary payroll deductions. And you might, and again, a company has the option of setting up what's called a group plan. And insurance companies love it when you can spread risk over a large group. So if you have 10 or 15 employees, which is what I look at as kind of a point which I need to start thinking about this, they're spreading the risk over that number of people. Here at Full Sail, we have 2,000 employees and their families. And that's a pretty good risk pool. So we get pretty good rates as a result of that. Plus, a lot of our people are younger. So those are the kind you really want to have in there because they tend not to use as much medical expense. In fact, they say that about 80% of your medical expenses in your life you used in the last 20 years of your life. So they love it when young people are in your health insurance plans, and Full Sail is one of these groups. Now, personally, they pay 3/4 of mine. I pay a quarter of it. So I pay about $100 a month. They pay $300 a month. What does that work out to? About 2 to 3% of my salary, just for health insurance. They give me a $15,000 life insurance policy for free. They have a 401k, which can only be offered by a company because it's managed by the company and they pay the management fees. But there's a retirement plan. We're tied into a group called the Principal, and they manage our retirement plan. Now, what Full Sail does is they will match it as an enticement for me to save money for retirement. They'll match 3% of what I put in. So again, that adds another 3% to that benefit. So we're at around 6% already. The life insurance I don't have to contribute to, but I'm sure that it has a value. It costs them money, maybe 0.5% or so. But all of these things, these group plans can only be done by companies. So you have to decide whether you have to provide these. Employee stock option plans, you can give stock to your employees as compensation. If you give them stock, the actual certificates, when you give it to them, it becomes income, even though they haven't converted it to cash. And so you have to collect taxes on that in some cases. Depends on the state. Options, those don't really count until they exercise the option. They usually are good for a year, and then they have to decide if they're going to execute them or not. I always tell my students that if you give stock away, put a tail on it. In other words, if you say, I'm going to give you 100 shares of stock, but it's not really yours for the next 3 years. And the reason you do that is because you don't want them just to run to the market and sell them. You want that person to stick around for 3 years before they actually can sell it. But the idea is it's an incentive. It's an incentive to stay. Same thing with options. The way options work is you give it to them today, your stock is worth $1. That's the base in their compensation, that dollar. At the end of the year, if your stock is worth $4, they can sell the stock. They can exercise the option, take the stock, which they pay $1 for, and then turn around and sell it for $4 and keep $3. That's income to them. But if your stock is not worth $1 at the end of the year, they don't have to exercise it. So in other words, they don't have to buy the stock. It just expires and the stock goes back into the company. But the incentive is let's work hard with the company so the company's worth more, so my stock will be worth more a year from now, so I'm going to exercise my option. A lot of companies use options as an incentive. In California, they actually tax you on it because, again, so many businesses were paying them with the stock options that the state was not collecting enough tax. So they said, okay, we're going to tax you at 10%. So they make you, if you say, I'm going to give you stock worth $100, you had to pay $10 to the state as kind of an incentive for to pay their taxes. And so again, there's There's lots of rules out there. Make sure you understand. This is, again, another good reason to use a service. Meals, uniforms, union dues, all those are things that you can do, and you can pay them. And this is, again, you're providing these to your employees. Think about a company car. You could provide a car to your employees. And again, all of these things are perks, or benefits from the company, but it's money out of your pocket. So you have to decide, is it worth it to me? These can be done with pre or after tax dollars. Now, the government is very good at giving you guidelines for all of these things. But at the same time, if you're working with money before it's taxed, like you're allowed to put $2,500 into a fund, which you can now pay your health insurance or buy the stock, or I think you can use it for daycare and things like this. If you don't use up all the money during the year, the government gets to keep it. So that's their little carrot and stick that they set up. But 401ks can only be done by companies according to the government. If you don't have one, they're required. They're going to be doing their own retirement plan. They're going to have Social Security. Plus, if they want to save money, they can set up an IRA and stick in up to about $16,000 a year. You, as the owner, can also set up your own retirement plan. So you have to think about, is the company going to do it, or am I going to have to do it myself? And again, if it's an incentive, it means the company is going to be contributing to it. Now, we have had cases where the health insurance, if you can't afford to do it, but you have a big enough group, you might be able to save them money by pooling them together. And you can tell them you've got to pay all the premiums. And says, we'll contribute if we have money, but for the most part, we're making it available to you at a discount, but you got to pay the bills. And so you have to decide if you want to do that. Now, the Paychex and ADP, who are two of the big payroll services, they'll pool you with other companies and set up a pool through them, which gives you, again, spreads the risk. And so, you can cut your costs that way too. But again, we're talking about money that you're going to have to pay out. It's not unusual to give 3 to 5% in the beginning. You're setting money aside to pay these. Now, if they decide they don't need it and it's not required, that's their choice. It means you don't have to pay for it, but you're the one who has to set it up if you're going to set up a group plan. But again, it's up to you. 3 to 5% is a good number. 10% is okay. Much more than that, the government may start to look and say, well, this is a luxury. There's a cap on how much you can contribute. So again, your lawyers, accountants, and your payroll people will tell you what the laws are. That's the voluntary side. Now, you also have those tax deductions that are required by law and require that you do the capture of them. When you hire people, you do an I-9, which is your immigration form, and they're required to have that to prove they have the right to work in the United States. And then you also will do a W-4, which they'll put in how many deductions they have, which determines how much tax you withhold. Federal tax you withhold. And once you have those, you can go to the tables and figure out how much money needs to be withheld from their check based on what their tax rates are going to be, as they talk about Publication 15. That's a IRS document. You withhold federal tax from the amount that you pay them. That's taxable, which is their base salary, minus any pre-tax deductions. Determines how much federal tax they have to pay. You don't contribute to this at all, but you're now the collector for the federal government. You have to collect it and send it to the federal government every pay period. and they do that electronically. This is why the Fed never really runs out of money, is that there's a constant flow of federal income tax, Social Security, and Medicare coming in. So, when they talk about, well, we're broke, it means they can't borrow. They're spending more than they take in, and so they have to borrow it from somewhere else. But there's a constant flow of money into the government because every pay period, companies have to send the money they've withheld from people's checks. So federal tax you don't contribute to, bounce down to state income tax. Now, Florida does not have a state income tax, so we don't have to do any withholding, but about 2/3 of your states do. And it's actually more than 2/3, about 3/4. So you have to look up what their tax rates are. Most of them are graduated. In other words, they start at 0 and work up to the largest one is California at 13.3%. So you have to withhold state tax and send it to the state. Social Security is the retirement plan for people in the United States. We were looking it up in the, you have to collect Social Security up to $128,900, I think it was, about $129,000 of income. You have to take 12.4%. Now, if they're your employees, you pay half of that. So this is more money out of your pocket, 6.2%. Then you have to take 6.2% out of their check. And again, you're sending this into the government every pay period, but you pay half of it. Same thing with Medicare. Now, Medicare is not capped. Medicare is 2.9%, which you have to collect on all of their income every pay period. You pay half, you take half out of their check. So that's where that 7.65 on your spreadsheet came from. Now, this works fine until you get up to 5 employees. Once you have 5 employees, you now have to, depending on your state, pay workman's compensation or disability and unemployment insurance. Now, these are programs that have been set up by the government to help the workers. And, one thing your government's going to do is they're going to protect your workers. And so once you get to 5 employees, you're going to have some more fees you got to pay. And that's your workers' comp and unemployment. This is why there's a little note on the side that says, once you get to 5 employees, you got to kick up your payroll taxes by at least 5%. Different states have different levels. They start you at a different level in each state, depending on what the range is and how much they pay out. So you have to think about, you have to look at each of your states as to how much it is. Now, like in New York City, you have a 9.62% state tax, but also a 4.25% city tax. So if you live in New York City, you're looking at another 14% coming out of the paycheck. And those are the, those are the kinds of things that you got to pay attention to. Now in New York, there's also employer taxes. Same thing with San Francisco. If you want to operate your company out of there, they have a tax on your payroll. And so you have to, again, make sure you're aware of all of these taxes. And again, this is why, like I said, you need a good attorney and a good accountant, but also use one of these payroll services, because especially if you deal in multiple states, because you can't be expected to keep up with all the law changes and do your job, especially in a small company. So it's worth that $25 a month to have a payroll service process your checks. Make sure you're in compliance with all the state and federal regulations. So I look at 7.65 up to 5 employees. Once you hit 5 employees, it's going to go up to 12.65 minimum. As long as you do that, I'm happy. It's going to get you close. But we had one student who was in California. I think he had 20 employees. His payroll taxes were over 20%. He was in a high-risk business that had high workers' comp and high unemployment, and so they were hitting him for a lot of taxes. And again, this is money out of your pocket. This is the thrill of having employees, is that you now get to pay half their Social Security and half their Medicare, plus these other taxes. Now, a lot of these taxes are set by the federal government, and they're very good at what's called unfunded mandates. In other words, you need to pay this money, but hey, we're not going to contribute. And so they go to the employers and say, guess what, guys, we're going to require you pay this stuff. And there's not much you can do about it because you have to do it. But unemployment, if you lay a lot of people off and they make claims against you, every year that can go up. And it can cap out somewhere around 9% in some states. Same thing with workers' comp. If you have a lot of people, if you have a dangerous profession, people get hurt. Think of a stuntman or a place where a lot of power equipment is operating. You might have people getting injured and they can't work. Well, those claims go against you and your company, and they make sure that there's money there, so they're going to come back to you for the money. And because again, the government's not kicking in on this. Now, on unemployment, one of the things the government did was they extended it from 26 weeks to 96 weeks when the recession was there. And they went, we're going to help the people. Well, the problem is they didn't have any money to contribute, so they went to the employers and said, guys, kick in extra money. And so they made us kick in 2 to 3% of the payroll to fund it, so that the fund had enough money to take care of these people. It does happen, and it has happened in a lot of states where that fund starts running out of money. Well, the state doesn't have any money to put into it, and they just basically tell the employers, you've got to fund it, and they would send us a note saying kick in more money, and we'd have to do that. But those statutory things are by law. Now you have state laws, federal laws, even cities have can have their own tax on you. So again, think about what all this might mean to your business and how much it's going to cost you. And if you're not sure, like I said, these payroll services will tell you what the numbers are, because that's what their job is. And again, I use them because it keeps me out of trouble. If I do it myself and I mess up, I'm the one who gets fined. If they mess up, they pay the fine. And so it doesn't take but one of those to make using their services worthwhile. So again, the idea here is make sure you understand paying them a salary is not the end of it. You also have to collect the taxes. You have to contribute at least 7.65% to the pool. So it's another 7.65%. And are you going to offer any benefits? All of those are additional costs for having employees. Now, we were talking about using contractors. The difference with contractors is you basically pay them to do services. You're not having to collect any taxes. You don't have to do any of this if you have them. Now, we still want you to have one employee, but you could outsource the other jobs. Just remember, with consultants, they work for other people. They may not be available when you need them. Employees, you can tell what to do. You can tell them what time to show up for work, how long they have to work, what their job is. Consultants, you're not really supposed to be doing that. And if you treat consultants like employees, they can actually file with the IRS and get these taxes from you. That's the negative side of it. This is why I always tell my people, the ground class, that if you hire consultants, make sure that they are an entity. In other words, LLC or corporation, and there's lots of consulting companies that'll rent you people. The reason is because you're paying that company. If you do that, you don't have any more paperwork. If you pay an individual to come and work for you, the risk is that they can say you were treating me like an employee and cause you trouble. Also, if you pay them over $600, you're supposed to be reporting their income with a 1099 at the end of the year, so you have a little more paperwork and tracking and stuff. That's why a lot of companies require that their consultants come from a third party, because then you're paying the third party. They're responsible for paying the employee, and you get a temporary worker. I did that with a CFO one time, and basically for $1,000 a week, he came in 1 day a week, worked his butt off. Hours didn't matter, because again, I couldn't tell him when to show up for work. He came in, got all the work done in a day. So I'm not having him sit around 4 days a week collecting big money for $1,000 a month, for $1,000 a week. He came in and got everything done. And I got a high quality person because I could say who it is that I wanted. And I ended up with a controller from Hertz from Europe. So he understood currency conversions. He understood international laws, and that's what the company was a international internet terminal company. Those were the types, those are the kinds of things you have to think about is, do I need somebody now, or can I use that consultant the first year and then not hire that person? Because again, the person we ended up hiring cost us $150,000 a year. So you're looking at $12,000 a month. I was getting a guy for $4,000 with the same experience, but like I said, I didn't need him. So, why spend the money? So it's really up to you. But like I said, the key thing is once you hit 5 employees, new rules set in. And same thing with other laws, discrimination laws. A lot of those don't kick in until you have 10 employees. Requiring having health insurance, that doesn't kick in until you have 50 employees. Oversight by OSHA and Americans with Disabilities Act, those don't kick in until you have 10 employees. So you have to understand what laws might affect you. Actually, you can discriminate. Some of the laws don't kick in until you have at least 5 or 10 employees. So you can actually do whatever you want till you get on the radar of the Labor Department. But most of your states require that you hire somebody. If you hire somebody, you have to report it within 20 days, and then they start tracking everything. So they're going to want to know how much you pay them, withholdings, all this kind of stuff. They're going to help you with that. But you've got to work with the state to collect the taxes and all that stuff. And the states are the ones that run your unemployment and your workman's comp pools. So you've got to work with your state labor department. The Fed, the money gets transferred electronically, so you really don't see it anymore. Used to be that you could, if you were a small company, you didn't have to send those taxes, but every quarter. Governments changed that, and they basically say you have to do your payroll electronically, and you have to send us the money immediately. So again, the government wanted their money fast. So they require you as a business, and software like QuickBooks, they have that in it. They have the electronic transfer, so it's all there. You still have to set the numbers. Now, the only time you don't have to pay minimum wage is if you have tipped employees. So if you've got a restaurant, I know several of you in this program had restaurants, you only have to pay, I think it's in Florida, it's $5.71 an hour. And they require you pay them something because they want you to withhold the taxes. If they were 100% commission, there's no money to hold taxes off on. So they require that you pay at least for tipped employees. It's a little over half, and it's mostly so that you can withhold taxes on what they say they earn, and they've got to tell you how much their tips were. I've had some some people that have tried to track it, and it's a nightmare. So I know when we went into a restaurant, we basically told the employees, look, guys, we know that you're tipped. We're assuming that you make minimum wage because that's what we have to. We're accounting for, We're required to account for. So that's what we're going to do our withholding on. If you make more than that and you want more money withheld, you have to tell us. But everything's on you. I've done my legal requirement, which is pay you minimum wage. And that's what my withholdings will be based on. It's simplified. It took a day out of the time it took to do payroll because we're not having to go into the computer and find out how much was charged, a credit card for each of these people, especially when you have a lot of employees. And then you put the onus of taxes back on them, and a lot of them, are trying to get unreported income anyway. But legally, you're covered. So that's what we used to do in the restaurant. The bartender, the servers, and everything that have tips. We just say you're making minimum wage. That's the taxes. If you want us to hold back more on your W-4, tell me how much money to withhold. So it's really up to them. But you just need to do what you are legally required to do. Okay. In addition to staffing, you've got startup costs. Now, your startup costs are the money you spend before this business plan kicks in. So before January in your marketing budget, this is the money you're going to spend. It can be as low as $100. I've had it as much as $600 million. Somebody was buying a cruise ship. But think about if you could get everything you wanted to get the company started on the right foot, what is it? And that's what we're working on here. Now, if you are going to buy property or like your office, that's a facility. Now, the reason we separate them is because of depreciation. Now, the government right now is enticing companies to spend money. So the amount that you can write off each year in terms of new purchases is up to $5 million. It used to be around 100,000, but it's been going up as they try to get people to spend more money on their companies. And they'll let you write that off against your revenues for the year. Now, most companies are trying to spread the depreciation of their equipment over the time that the equipment has a useful life. And the government tells you what that is. They have a book that says a building will last 29 and a half years. How they got there, I don't know, but that's the number we use. So we take, if you decide you're going to buy a building, you need to put the full value on there. Now, we separate the land and the building because they said the way they feel your land's not going to be destroyed if there's a fire or a storm. And so they don't let you depreciate the land, but you can depreciate your building. So if you build a building, that you put the whole value here if you're going to own it. If you're renting it, don't use this. Just leave it at zero. You may improve it. In other words, if you buy a shell building or you rent a shell building and you spend $20,000 doing the inside, that's an improvement or remodeling. They do require you spread that out over 29 and a half years. This is one reason I always tell my ground class, if you're going to take an existing building, see what the landlord will pay for, because that's you want it in your rent rather than you wait over 29 and a half years. You don't plan to be there more than 5 years. You'd rather them spend the money and then charge you for it than to you have to just spread this over 29 and a half years. But anything in facilities, that's only if you like purchase a building or you remodel a building, as well as purchasing the land. But in almost every purchase, they separate the two out for you, so you'll know what those numbers are. I know when I built my house, they told me my land was 40,000, my house was 210 or something like that, and so I knew that when I started. Well, commercial property, they do the same thing. But again, use facilities only if you're going to own it, or if it's an improvement of a rental property. But the building there and land is only if you purchase it, and you need the full value, not monthly payment, full value, because that's how depreciation is figured. Under equipment, anything that's going to last more than a year, but less than 29.5 years, is going to end up in equipment. And the government has, they say furniture lasts about 5 years. A lot of equipment lasts about 10 years. Computers last about 2 years, and because again, they understand technology changes. So these are going to vary. We use 60 months because 5 years is about average, and all we're doing is estimating here. Anyway, again, if you buy a bunch of stuff and you put it in the company, and you decide to depreciate it, your accountant will take each piece of equipment and put a table on it. So some will be 5 years, some will be 3 years, some will be 10 years, but we just average it at 5 years or 60 months. So we take your equipment, divide it by 60 months, and that's how we figure your depreciation. But furniture, in most cases, you have to have a place to sit, place to work. Well, if you buy it, the government says it's going to have 5 years of life. It's going to divide that amount by 60 and give it to you as a non-cash fixed expense in your income statement. So, if you want to kind of spread it out over time, that's what they're doing here, is letting you write off depreciable assets over time. The production machines, if you have soundboards, I had a guy who was doing trade shows, so he had stages, he had sound equipment, lighting equipment, spent about $750,000 on that equipment because he wanted to be able to do 3 events simultaneously. That was all under production machines and equipment, and again, depreciated on average over 5 years. Computers and software, again, we're doing it over 60 months, but you'll find that your accountant will probably do it over 2 years. But again, think about how much money you're going to spend, or how much money you're going to need to spend if you could have everything you wanted. Cash registers, if you're running a store, you have to have a point of sale system or cash registers to take the money. Those aren't free. And so, again, just think about the money you're going to spend before you can get the company started. If you're going to have company telephones and any other depreciable equipment, you could have a phone system, internet system. Again, all those things, there's a lot of hardware involved. The government usually wants you to depreciate it over time. Now, there's about 5 different depreciation methods. We use straight line, in other words, divided by the number of months. There are other systems that let you write it off quicker in the beginning, but you get less write-offs later on. Again, the more money that goes through to your bottom line, the more tax you've got. So you have to decide how you want to do it. And like I said, they'll let you write the whole thing off in the first year, most cases, if it's under $5 million. So again, you're going to talk to your accountant about what's the best thing for you to do. Now, once you're on the depreciation tables, you're stuck with them. So, you hear about Trump taking losses from bankruptcies and carrying those forward, and that's what you can do in a company. Now, as an individual, and again, if you're an LLC or a sub S, profits and losses are flowing through to you. The government only lets you write off, Well, in that year that you have the loss, you can write all of it off against your revenue. But if you have carry forward losses, they only let you do $3,000 a year if it's an individual and against money you make in the future. So again, think about what's best for you. And again, that's why your accountants or your attorneys get involved in this thing, because they're going to talk to you about what options you have. Vehicles, if you're going to have a company car or you're going to have a truck, we had a guy buy a tractor trailer to move his equipment. Those aren't cheap. So, again, those are ones that the government expects to last, 5 to 10 years. If you use a tractor trailer or whatever, it's not unusual for them to go 1,000,000 miles. So they know they're going to last a minimum of 5 years. So we write it off over that time frame. Now, the materials and supplies, those are things you're going to consume in the first year. And you have to think about, what equipment do I need on hand? Do I need paper, pens, stationery, brochures, pamphlets, forms? Do I need any inventory? If you have a store, you open the store and there's nothing on the shelves, what are you selling? Air? Or are they ordering it and you're buying it? Most cases you need some inventory, because again, you have to think about, like if you do events, first month you're going to do an event. How long does it take for you to get t-shirts, hats, CDs? 4, 5, 6 weeks. So think about what inventory you would need on hand. That's what this is. But the idea is, just think about, if I'm going to start this business in January, it's now October. What do I need to buy before I can open my door for business on January 1st? That's really what we're doing, is what money do you think you need to spend to do everything right? Because what we're going to be doing with these numbers is pitching them to an investor. So this is capital costs, money you're going to spend to get the company set up, and then it's going to start operating on January 1st. The fees and professional services, again, these are out-of-pocket things. As a new company, people don't know who the heck you are. So you're going to probably have to have a first month, last month rent if you're going to rent an office. So, what does that cost you? Because that's going to be out of pocket before you can open. In restaurants, it's not unusual to have 3 months of build out. Well, they charge you rent for those 3 months. So again, think about what money you're going to spend before you start making money. That's the initial, that's initial rent, deposits for, if you want to turn the electricity on. They're not going to know who the heck you are. So they're going to say, well, in your business, it's normally $3,000 a month for electricity. We had that in a restaurant, 10,000 square foot restaurant with 6 air conditioners. $3,000 a month. Well, they made us put up $3,000 before they turned the electricity on. I had to put up money for the gas, for the stoves, sewer, water, trash pickup. You had to get waste management needed to put a container outside. They charged me for that. All of that had to be done before I got an operational permit from the state to see my first customer. So again, think about what money's going to come out of your pocket before you can open the doors. Licenses and permits. If you're remodeling, in most cases you need a permit to do that. Those are $200 to $300 a piece. Trade and professional. You want to do it right, so you're going to hire licensed electricians, licensed plumbers. Those are trade and professional. Your attorney may need to draft contracts, because again, if you're going to be an agent, you have to have something to give, something to show to your clients. Well, you might have your contracts drafted ahead of time. The accountants need to set up your books. You need to get your insurance in place, because again, you open the doors and there's no insurance. First person who walks in slips and falls and sues you. Guess who gets sued? It can put you out of business the first day, and we've seen that happen before. So again, all these things need to be in place before you can start seeing your first customer. You might have a marketing push. You know, one of our guys spent $150,000 on advertising and promotion to find out which methods worked, and he had his investor pay for that. And he tried email, regular mail, telemarketing to see what worked, and he ended up placing ads in the magazines for the pharmaceutical industry. He found that email didn't have much of a response. He found that direct mail didn't have much of a response. The people were scattered all over the country, so TV and radio didn't work. The only thing they had in common as a target market were 2 magazines. So he found that that was the best way to reach them, and he used a kind of a pre-open blitz to find out what's the best way to reach his target market. And again, you're going to the investor and saying, hey, I need to do an email blast, or I need to do a blast so people know I exist. You know, because again, you open your doors on a business, nobody knows where you are. You know, they might find you on a website, but for the most part, you want to drive people to your business. So that's what you can do with your startup costs. Now, that total capital cost, that is all of this stuff added up. How much money do I need in order to get this company started? Because what we're doing is we're trying to reach a number that we need that either has to come out of my pocket, or I need to find an investor that can put this amount of money up. And I'll go show you one. The working capital, what that is that's the cash you need in the bank to get you to the point where the company is self-sufficient. Now, with my guy who was doing his pharmaceutical sales, he by the end of the first year, he was losing about 100. He had lost about $150,000 because his revenues weren't exceeding his expenses. Expenses still need to be paid. You know, your salaries, your rent, all that stuff still need to be paid. So he needed at least $150,000 in cash to get him to the second year. And that's what that's what working capital is the cash you need to get you to the point where, oops, I don't have it here. I'll show it to you. To get you to the point where your revenues exceed your expenses. Yeah, pull up Kip's. Now, Kip, like I said, he was pharmaceutical sales conventions. And let me go to his. Let's go this way, staff. So his startup costs were $1.3 million for his capital costs, and then we figured his 3-year working capital needs were $150,000. Now, where that comes from in your monthly marketing, there's a line down here for summation of cash flow. What we're trying to do is determine how much cash you need on hand to get you not only to the next month, but also to get you to the point of profitability. Now, as you can see, the first month he needed $41,000. Second month he needed $79,000. Even though he was losing money in his books, you notice that the amount of cash he needed actually went down. Now, the reason is because of depreciation. His depreciation was fairly high, but this is non-cash. So we figure how much money you needed, and we adjust it for the depreciation. And we do that because it's not actually cash that you need, because it's the government saying, I'm going to let you save some money because you're going to have to replace this equipment later. So they're letting you depreciate it over time. And we're estimating that for you. Now, if you notice, his largest negative was 135, but just make sure you look at all 3 years. So in year 2, it went up to 139. Now, in his case, this was the largest negative cash flow. So if you put 139,261 in his working capital, you would be correct. I always round it up to the nearest 25, so that's why I put it at 150. Now, if you say you never lose money, 0 is correct. But what if you were wrong? You have nothing to fall back on. So I always make sure that you can cover your first 2 months' expenses. So if you notice, these two add up to about 150,000. So I'm covered. Now you would adjust these for depreciation, but basically 150,000 would take care of the company for the 3 years. And basically what you're saying is, I'm going to ask that investor for $150,000 in cash, in addition to the 1.3 million in capital. Now, if you're the investor, basically he's saying, I need $1.5 million to start the company. Now, with Bill next month, he's going to talk to you about if you have money to put in versus you're going to get loans or whatever. He's going to talk to you about that. The way I look at it is, you need $1.5 million. I'm assuming you need that from your investor. So I'm going to then go to your assumptions tab and say, okay, you need $1.5 million. How are you going to pay back the investor? Now, for the class, all we ask is you make $1 in your 3rd year. But I can tell you it won't be attractive to an investor, because that's where they get paid back. As you can see on here, he made about 1.25 million over 3 years. That's not $1.5 million if that's what he was asking for. So investors are going to go, when am I going to get my money back? So they're going to be looking to not only get their money back, but also make a profit. So it would be a little tough sell here. Now, if you were only asking for half the money, $750, you could pay them back in 3 years with a little bit of a profit. But I can tell you, most angels are going to be looking to double their money. So they would be looking for 1.5 million over 3 years, and you decide how much of this profit you give to them. And in the film industry, what they do is what's called 80-20. 80%, they give the investors 80% of the profits until they get their money back, and from that point on, they get 20%. And so you can decide how you want to pay back the investor, but you have to tell them in advance. So you have to think about, if the other half's mine, do I want to go 3 years without making any money other than my salary? That's why we make you put a salary in there, because we don't want you living under a bridge or in your car. So we're going to make sure you get paid as an employee, and then if you get the profits after that, that's icing on the cake. That's what we're talking about here. But I would make, again, I'm going to look at that $1.5 million, and I'm going to go, how am I getting that money back? And that's mostly just, if you're pitching it to investors, that's going to be a problem. Now, in his case, he was putting most of the money up himself, so he can decide what kind of a return he wants. The other thing I look at here is this 5% profit. It's not a lot. Now, 5% is about what supermarkets make, but they're well-oiled machines. You're not usually. So banks, for example, have to go through stress tests every year. And they basically come in and they will go through their books and pick 3 or 4 clients and say, you just lost these clients. What happens to your business? And that's what we're talking about here. If you lost 1 client, would that send you negative? Probably. Because $175,000 for an event, you lose 1 or 2 events, that's going to have a significant impact on your profitability. And so that 5% is really not that great. I like to see it around 20%, 20, 25%, because then if something bad happens, you're going to have some revenue to fall back on. But again, for our class, all we ask is you make $1 in year 3. Okay. The last thing is your mastery assignment. Let me get out of here. Is your mastery assignment. And let's see if it's still open. Yep. And in your mastery assignment, the key thing we're looking for here is based on what you did in your is what you wrote as your goals in your mastery class. You know, parallel those with what you got out of the class. And so, again, it's just a reflection on your experience in the class. So again, a 300 words, I've got to read it for content as well as for accuracy. What do you call it? Spelling and punctuation and all that good stuff. But most people do pretty well on this because, again, you had a preconceived notion of the class. What did you get out of it? I just had a real nice comment from David Tripp, one of your clients, one of your people here in the class. Is David on? I haven't looked at the attendance. No, but David sent me a note just a couple minutes ago that he had to go to court because he had a copyright case and he won. And he said, just what I learned in my program has now paid for itself just in that one case. And he said, because he actually represented himself because he said, my attorney wanted $7,500 to show up. So he represented himself, presented his case, judge threw the case out because he said it was somebody was going to try to force him to sell the music that he had created, and because she wanted all the revenues from it, and he said no, and so she took him to court to try to force him to sell his intellectual property to her, and the judge said no, you can't do that. So he represented himself well, but he sent us a nice note to say what I learned in the program really just saved me about $7,500, as well as I got to keep my music and I'm going to make revenue off of that. So again, staffing, need at least one employee. Just remember, when we were looking at the Census Bureau, one of the things there was what each employee adds to your company on average. So again, you can look at those numbers and say, okay, if I'm going to make $1 million, how many employees will I probably need for my industry? In most cases, it's about $300,000 to $400,000 per employee. Let's see, question. Yeah, he did really. I had a nice conversation with him on Sunday because he was preparing for court for Monday, but he sent me a note and said that the judge threw it out because she had nothing to stand on. I mean, he was being paid to provide a service, which he did, but he kept the rights, and you can't force somebody to sell something that's theirs. So we'll see what happens. We're actually going to use him in Cassie's class now as a example. I like to use student examples whenever I can. But again, have at least one employee full-time, pay them at least minimum wage. We like to see a little more than that, but again, minimum wage is all that's required by law. If you have more than 5 employees, you're going to have to start paying workman's comp and unemployment. So jack it up if you get to one. If during that year you get to 5 employees, you're going to have to pay it. And then in the startup costs, think about what money you're going to spend before you start your business. And again, it doesn't have to be a lot of money. You may just buy a computer and rent an office. But, again, think about if you could get all your toys you need ahead of time, what would it cost? And because we're going to go to an investor and say, this is what I need. And you're going to be presenting that to them and make sure that you get your working capital correct. Again, go to the income statement. It's not complete yet. I understand that. But look at it, round it up to the nearest 25,000, because most investors will give you 10 to 20% fudge factor. Round it up to the nearest 25,000. But if you don't have that cash, if you, at the end of the first month, if you're short, in his case, $40,000, you're actually insolvent. In other words, you can't pay your bills. And so you're basically done, you know. But you need to have some cash to pay your bills until the company can survive. So that's what that cash flow is telling you is, I need X number of dollars, and you're looking at the largest negative number. You're gonna put it in positive in the startup cost, but this is the cash you need to have in the bank at one point in time to make sure that you can cover your bills until the company is self-sufficient. And most investors understand that it takes money to get to the point where you're self-sufficient. And as long as they know ahead of time, you don't have to go back to them. That's the bad part. When you have to go back to them for more money, that's when you tend to get into trouble, and it costs you too much. So that's it for this week. I appreciate y'all being on all month. I have posted these in my SA Burho on YouTube. I'm gonna shut it off now in a second.